Hi everyone. Today I wanted to talk about an interesting article that I came across on Bloomberg, which basically talks about this new hustle popular among young investors and making waves in the investing world. It's not crypto, it's not meme stocks, it's dividends. And the logic behind this is both fascinating and a little alarming. I'd love to hear what you all think about this. But first, quick intro. My name is Molly and I used to be an investor at a $4 billion fund. Everything I learned on the job, I'm here to share with you to help you invest smarter. So if that's interesting, hit follow. Now, back to our topic. Young investors are piling into dividend ETFs. Most aggressive of these, offering yields above 8%, have quadrupled in size in just 3 years and now hold around $160 billion in assets. The appeal for many is simple. Replace your paycheck with dividend payouts, retire early, escape the 9 to 5. But that's really not how it actually works. Dividends often come at the expense of price appreciation, and they're not what make you wealthy over time. The article highlights a case study using a fund called MSTY, which tracks the stock of a Bitcoin hoarding company called Strategy. If you bought that stock directly in 2024, your $100,000 investment would now be worth $463,000. But if you bought this STY ETF and reinvested dividends, you'd end up with about $343,000. And if you withdrew the dividends, like many do to generate income, your total value would just be $270,000. The value of your ETF holdings alone, that's less than $73K. That's the core issue. In strategies like these, dividends are the bulk of the return, and if you spend the cash, you're left holding a declining asset. This specific fund has about $5 billion in assets and promotes a 90% distribution rate. But those payouts don't come from real business income. They come from a complicated set of option bets that generate cash for monthly distributions, but that also drag down long-term performance. In my view, this whole approach is short-term minded, naive, and frankly self-destructive. You're trading long-term wealth building for short-term cash flow. The stock market is one of the most powerful tools for wealth creation, but that only works if you let compounding do its job. Funds like this tap into anxiety around jobs, inflation, and uncertainty, and they promise control and income, but they come with serious trade-offs more investors need to understand. One thing to keep in mind are taxes. Dividend stocks already come with additional tax liabilities since each payout is a taxable event, but it's worse with high-yield derivative-based products like this. The distributions here do not qualify for lower dividend tax rates and are taxed as ordinary income. Now, this is not to say you should not invest for dividends. In fact, it is great to have dividend stocks as part of your portfolio. But relying entirely on leveraged, high-yield dividend ETFs for income, that's trading long-term growth for a few quick checks. I get that the stock market can feel intimidating or rigged or too complex, but this isn't smart. That's exactly why we're building Finvest to make it simple for anyone to invest in stocks, ETFs, and treasury bills, all in one place, so you can have a balanced portfolio that helps you build long-term wealth. Our features like investment insights and scorecard are built to help beginner investors make good and informed decisions that help them and not hurt them. If you're serious about building wealth, don't chase shiny new objects. Build the foundation. Finvest can help you with that.